Hello again, everyone. This is Chris Thomas, one of the mortgage experts. In this video, we will discuss mortgage insurance. What is mortgage insurance? Mortgage insurance is an insurance policy that is required on loans that are for amounts greater than 80% of the value of the property, or the sales price, whichever is lower. The borrower pays for the insurance policy, and the lender is the beneficiary of the policy if the borrower goes into foreclosure. How are mortgage insurance rates determined? For conventional loans, MI rates depend on a number of things. For example, the size of the loan, the borrower's credit score, the down payment amount, the property location, and the terms of the loan, for instance 30 years, 15 years, etc. For FHA loans, mortgage insurance rates only depend on the down payment and the terms of the loan. We are often asked what PMI is. PMI stands for Private Mortgage Insurance and is mortgage insurance from a private company. PMI is only used with conventional loans. FHA loans also have mortgage insurance, but it is paid to the federal government. There is no private mortgage insurance company involved. It is referred to as MI and not as PMI. When does mortgage insurance go away from a loan? With conventional loans, it automatically goes away when the borrower has 22% equity in the property, based on the purchase price. The borrower can get it removed earlier if they can prove that they have 20% equity in the property. That will require an appraisal. Most lenders require mortgage insurance to be paid for at least 1 year, regardless of the equity. With an FHA loan, mortgage insurance automatically goes away when the borrower has 22% equity in the property, based on the purchase price, just like a conventional loan. However, mortgage insurance must be paid for 5 years with an FHA loan, regardless of the equity in the property. The borrower cannot get the MI removed early by proving that they have sufficient equity with an appraisal. What is lender-paid MI? Some lenders offer loans that are advertised as not requiring mortgage insurance. They really do have mortgage insurance, but the lender is buying it themselves, usually without telling the borrower. Interest rates are higher for no MI loans, and overall payment might be lower, but the payment never goes down, regardless of the equity the borrower has in the property. It's always best to consider lender-paid MI and borrower-paid MI when getting a loan that requires mortgage insurance. Here are some additional things to consider. FHA loans require an upfront mortgage insurance payment of 1% of the loan amount. This upfront mortgage insurance can be added to the loan. It is not required to be paid in cash at the closing. If a borrower gets 2 loans and neither one is greater than 80% of the purchase price, there is no MI required. Here's an example. Let's say the purchase price is $100,000 and one loan is for $80,000 with a second loan for $10,000 and a $10,000 down payment. In that case, there would be no mortgage insurance required at all. A third thing to consider is that VA loans never require mortgage insurance. If you are a veteran or otherwise qualify for a VA loan, you should always consider that. When you're looking for a mortgage, you need an expert. If you're a real estate agent and you've ever had a deal fall apart, it's time to start referring the mortgage experts to your clients. If you're a consumer looking to buy a house or refinance an existing mortgage, you need expert advice. Call us, Chris and Debbie Thomas, the mortgage experts, and you'll get the advice and the mortgage you deserve. If you'd like this tip, check out all the tips on our website. Tell everyone you know about the mortgage experts, and call us with any questions you might have.